Live streaming is on.
Ladies and gentlemen, welcome to our September edition of the Trader Strategy Meeting. For those who may not know, this is where we bring our whole trading team together and we discuss some themes that we may be seeing over the course of the next several weeks. And what we usually like to do is kick things off from a macro perspective and work our way down. And that means we can bring in none other than Brett Manning, aka Chart Trader. How are you today, my friend?
I'm in pretty bad shape, Jim, but I'm going to fight through it.
All right. Well, I like the fighting spirit.
Yeah.
So since we're going to talk about a macro level, why don't we start with what we're seeing recently with some pretty clear markers of sliding economic growth optimism, particularly with this August economic data being a big part of that. So the real question is, was this August just a one-off outlier, or are we seeing an actual turning point?
Right. So I think I think that's unquestionably the big question right now. We saw weak jobs growth, really poor consumer data, consumer sentiment, weak retail sales. And now we see this, what looks to be like a turn in CPI trend. And that can be framed, like you said, as an aberration that's part of a continuing trend that'll snap back. And it's just really that was the most intense period of maybe the Delta spike in the US and China. But it could also be framed as the beginning of a new trend sliding back towards what you might think of as like the lower for longer, slow growth kind of economy that existed before COVID ever appeared. So basically defining the prior decade, the so-called new normal that we were going through. And that's really important. And if you want to throw that chart up I sent you, it's important because the surge in equities that we have seen following the COVID crash has been parabolic relative to the rate of growth priced in before COVID. And this chart shows a violation of the upper boundary of the long-term trend channel. And it's particularly important because this is a logarithmic chart. So it would look, much more egregious as a violation of that upper boundary if I was using a linear scale chart. This is a weekly chart of the S&P continuous contract futures. But even on a logarithmic chart, it's turning parabolic, which means it's pricing in a new form of economy. And following August, I think that faith in that thesis is starting to be questioned. And that makes upcoming econ data, particularly following August, especially if we see a Delta rollover, extra important. Because we just saw a pretty steep drop in the latest week over week comp for cases for Delta, and it could be starting to roll over. But the new fund manager survey from Bank of America was out yesterday, and it shows a couple of really important things. One, the main thing is a dramatic drop in macro growth expectations without a paired drop in tapering expectations. So fund managers are starting to expect that we could see a downshift in the nature of the growth environment that we're in and still see the Fed start to taper stimulus before year end. And since we're seeing a drop in growth expectations and no shift in tapering expectations, and since another item in the same note points out that Delta would be the most likely culprit if tapering were put off, we can basically infer that the large fund managers in this survey, they're downgrading their growth expectations independent of Delta. So it's not about Delta. It's just a post-peak growth return to new normal kind of sentiment shift. And one of the most striking charts in that piece is the relationship between how many expect a stronger economy ahead, which has dropped like a rock in the past month, and how many still report being overweight equities, which hasn't dropped. And I think that relationship may account for some of the distributive feel that we're seeing over recent days, reconciling those two ideas. Um, but I would say, obviously there's a flip side to all this as well. You could also say that this is an argument for a next leg higher and a blow off. If we start to see a shift back up a gear in terms of growth data as Delta tails off, especially if we see another dip in CPI paired with that strong growth, which would help to confirm this idea that, it's not really, those two ideas aren't being driven by the same engine, that there's this bottlenecking, this transitory notion about inflation, that as we start to rebuild these supply chains, well, you start to see that pressure lift off. We could still see stronger growth, but the Fed would still have extra wiggle room. If all of that came together, and at the same time, that was following a period where large money managers were shedding equities exposure, then they could be caught with their pants down, and if we start to see that type of shift, and really that ends up being the fuel for kind of a blow off leg. So I think there's a couple ways to look at the situation, but right now, I think one of the main things we're starting to see in evidence is a real shift in the way that people are extrapolating economic data, and so that's going to make upcoming data points really, really, really important.
So, Brett, taking that into consideration, I want to know what your take might be. Let's say we see data that, we'll call it, rhymes with what we've seen in August. How many months of data do you think it would take in order for the Fed to maybe start shifting their position, where maybe an end of the year tapering may not be baked in?
I think it would take sharper than just kind of downgrading trend. I think it would take, some really sharp shifts in the nature of what's happening. And I think that probably the main thing that would cause the Fed to make this change is probably if Delta didn't roll over. I think that would be more likely, where they're looking at contextual factors. They've got their own models. They don't really change on, one data point. Like you're saying, you'd need a series. I think that it would probably be the money manager's perspective is certainly going to shift a lot faster than the Fed's. And we know this. So the Fed is going to be putting it all through a model, and they're going to be looking at rolling averages, and rather than 1 or 2 months of shift. We've seen this before. I think it was the summer of 2019 when the Fed stayed to their slower inflation model, even though we saw a couple of months of pickup. And it kind of, it took 3 or 4 months, and they just stayed with their model, and eventually they turned out to be right, and it kind of passed by. I think it was 2019. It might have been earlier, but we've seen this several times where they have a perspective, they've got a policy path, and you start to see some data that's aberrant from that path, and they're weathering it for several months without making a shift in their policy pathway.
All right, I want to bring Gavin into the conversation and let you two reflect upon the reaction that we saw today, meaning we had the S&P futures. I'm going to drop this chart back down. All right, so we saw a big pop after the CPI data was released, and we reversed that, and we picked up a little bit of a bid towards the 4440 area. Now we're right back where we were essentially when the CPI number came out. So I want to get both of your take as far as the reaction we're seeing. Is the market telling us anything new right now? I'll start with you, Brett.
So I think that it is really the reaction to the CPI data sending the bond market through the roof, and equities popped initially because of this idea that, where it removes the pressure on the Fed and confirms the transitory idea, but ultimately it's playing into this slower growth kind of modeling. And I think that, right off the bat, we had some pre-market shifts, and then we started to see an offer come in. And I would be surprised if we didn't see that offer reassert itself at some point. But I mean, obviously, if you've got a lower for longer kind of model that you're starting to build for, there's going to be a what did we see for the last decade? It's FANG out in front.
Right. You concur with that sentiment, Gavin?
Yeah, I would. I mean, I think what you had was a lot of people that were kind of leaning on a poor number. I know I was one of them. And then you just had that pop reaction and the squeeze higher. Certainly, there was evidence in that report that suggested that the Fed's transitory argument was taking place when you see where a lot of the declines were coming in terms of airfare and used cars and things along those lines, which the Fed had been noting is part of the reason behind the higher figures. So Once you saw that pull in, everyone was like, well, okay, well, maybe the Fed's got something right. But then you see the rollover here, and I think some of that has to do with some of the other numbers that you're seeing in there, which I think if if I heard you right, Brett, you're talking maybe not so much more about permanent inflation pressures, but inflation areas starting to simmer up in other areas that hadn't necessarily been a key driver. And I feel like that's why you got the rollover. Is that what you were kind of referencing, Brett, or am I putting words in your mouth?
No, I'm thinking if you've got people looking for a shift in expectations of growth overall, including inflation, that well, I mean, what sort of environment do you end up with after the pandemic is completely gone? Is it totally radically different from the environment that we had before the pandemic came along? I think that's one of the questions. I think that the market has been pricing in the idea that it is totally different, that it's a much higher growth rate, more inflationary growth. And I think that thesis is starting to be questioned. And I think we're just starting to see some extrapolation of recent data, including consumer sentiment and retail sales and some of the stuff that we saw in August in real time, and now this data point, and worse than expected jobs numbers. And if people are starting to flirt with the idea that we're going to be left in roughly the same type of economic context we had before the pandemic, as the dust settles, then that doesn't justify the move in asset prices that we've seen over the last 12 months.
Okay. So yeah, no, I'd broadly agree with that. I'm just taking a look at the reaction against the inflation number. As we saw, we got that rollover because I just think that people took advantage of that pop to, as Brett said, kind of straighten out their portfolio. We've been talking a lot about this last couple of days. I know Brett and I have both been looking for shorts to kind of play this dynamic out. Now, but when you're taking a look at the broader economy as a backdrop and how it could drive the Fed. I've been posting this morning a number of the comments that we've seen from JP Morgan, Wells Fargo, Bank of America. I got American Express that I'm going to be posting shortly here. And that cash transportation index that I'm looking at. And I would say that the broad picture that you're seeing, and it doesn't really come as a surprise, but there was a hiccup in spending around that August period on the consumer side of things, particularly in the travel and entertainment area. As you'll see, I'll have the American Express comments up here shortly, but it still is improving over the 2020 levels. That needs to be noted. Spending on overall products has not changed at all. It did not see any sort of a fall off in the month of August, and in fact, September for both T&E, travel and entertainment, and overall products has started to recover. So I think you're going to start seeing the story of any weak August data being kind of fluffed off as a temporary hiccup in the recovery from COVID. And I think that that's going to kind of work its way in to expectations for the Fed to continue to taper at the back half of the year. But I also think that it's going to ease concerns about any sort of fall off in the economy. JP Morgan on their conference call at the Barclays said that they didn't see any signs of deterioration out there in any of their metrics. In fact, we're starting to see loans slowly start picking up as people get a little bit more comfortable. And that, of course, is going to be a key driver to the economy. Now, the flip side of this comes in that cash transportation comment that I posted, where they're seeing some pretty serious bottlenecks, where you're starting to really see it take form is in the rail transportation, where they just simply can't keep up with the number of chassis that they need to transport everything. And the key theme that was being reflected there was seeing more of a move from rails back to truckers. So, I'm looking at the IYT, and that has a pretty significant exposure to rail. So I'm probably going to sit there. I'll ask Scott if he knows of any of more trucker related ETFs. And I'm going to be looking to move some of my money out from the IYT into this trucker area. But the key takeaway from that cash transportation index is that demand remains very strong out there. You're just going to see these supply chain issues continue to work its way into the lexicon, and how well companies are able to manage through that is really going to be a differentiator against on who's the winners and who's the losers. And I think Q3 is really, or the earnings season is really going to be a stock pickers market based around that. So overall, what I see is a pretty strong backdrop in the economy that should keep prices afloat overall. It should keep the Fed moving towards tapering towards the end of the year or at the beginning of 22 at a minimum. But given the COVID headlines, given the supply chain issues, there is going to be some chop in there that people are going to have to deal with, and I think that's kind of one of the episodes that we're going through right now.
Hey, Gav, so let me clarify something. So I
Sure.
wasn't saying I'm extrapolating a weaker economy. I was reporting what's in the fund manager survey that was out today.
Oh no, I didn't
Yeah.
think you were.
So
Yeah.
I mean, there's pretty clear evidence that large fund managers are thinking that August was not a one-off. So they could be totally wrong, and maybe that's
Correct.
the big opportunity here. And maybe what you're saying is, there's a lot of evidence that they're over extrapolating a single month blip that really may just be due to the spike in COVID. But there's clearly a lot of evidence in terms of what's in that fund manager survey that, hundreds of billions of dollars are being managed with the idea that there was one paradigm for growth rate as of a couple months ago, and that's shifted to a very different picture and a much slower growth rate at this point, even though they may very much be wrong.
Yeah, no, and I agree, and I wasn't saying that was your argument. I'm well aware that you're looking at the sentiment data, and that's why I just kind of wanted to include in what the banks are saying out there, which
Right.
doesn't necessarily mess up with that sentiment. And like you said, therein lies the potential for an opportunity. Now, of course, does COVID pick up again, which is very possible. Obviously, we don't have our fingers on that pulse completely just yet. So maybe we do see things deteriorate towards the end of September. And that's obviously what we're going to want to watch for when these banks start reporting their earnings in just about a month's time. Was the linearity in the quarter, did they see a deterioration at the end, or did they continue to see a bounce back from August? So far, based on the commentary that they're seeing, the early indication is that we are recovering from that little lull in August. So therefore, do we see this fund manager survey when the October numbers come out, which will be right when we start getting these banks? Do we see a flip in that sentiment? And I think, Brett, we'd agree that that's probably going to be the key item for the markets to understand how we're going to finish up 2021 over the next, and we should hopefully be able to figure that out over the next 3 to 4 weeks.
I absolutely agree with that.
All right, guys. So what we have lately is this, what I'll call conference season. And this has really been a preface into earnings season. And Gavin, you touched on it a little bit. And I think it's a good time to bring Craig into the discussion and let you two talk about some of the themes. What might be the tone that we're about to see coming into earnings season? Because we have seen a lot of guidance, and I'm just trying to get a sense of what you guys may be expecting. Is it a good look, a bad look, mixed look? What do you guys think?
Hey guys, excuse me. I think things are a little bit more mixed in Q3. I think a lot of it is the impact of Delta. Really the big issue is coming from supply pressures. So, we obviously saw all the airlines kind of guide down from Delta, but in general, I think we're going to be setting up for another strong reporting season, which kicks off in about a month. But yeah, it's not as, things are definitely going to get a bit trickier going forward. Q2 is just, nothing but blowouts and strong results because of the easy comparisons. And as Delta started to impact things here in the second half of the summer, it's going to make things a little bit more interesting. So stock picking is going to be more relevant than ever.
All right, Craig. Any thoughts from you, Gavin, as far as the tone? Do you see a mixed tone or something a little more bullish?
Mixed tone with regards to just the overall
In terms of the
market.
guidance that we've seen.
I from what I was seeing, it seemed a little bit more cautious. I know
Okay.
I'm just kind of going off of Sherman Williams and the airlines. I have not been paying as close of attention, so I would certainly be going off of Craig's comments on that. I know just as I've been posting up some of these bank reports here, what I would say for the banks is a lot of reaffirmation going on. Saw that with J.P. Morgan with its net interest income. Um, I guess you could say their trading revenue guidance is a little bit more cautious, looking at it to be down about 10% both sequentially and year over year. But this is always a softer quarter overall, so people don't get overly concerned on that. Loan growth seems to be improving, but I guess I haven't seen as much euphoria as we saw going into the Q2 earnings. When Craig, what did we end up beating? By like 73% on bottom line or something like that. Was it for Q2 earnings?
Yeah, I mean,
Compared to something astronomical
it
like
was a
that.
record, yeah, in pretty much any metric you look at, it was really strong.
And I just think we're going to see those margin expectations really reined in because of the higher costs of doing business and all. So that again is going to be a key item for Q3, where it wouldn't surprise me to see us seeing a little bit more misses on the bottom lines just due to some higher costs out there.
Right. And I have seen, we're seeing more cost pressures, supply chain pressures. And one of the things that Brett mentioned, that what I thought he said was more that lower growth expectations here in the second half or near term were sort of independent of Delta. But to me, it just kind of comes back around. It keeps coming back to Delta. A lot of the cost pressures or supply chain pressures, if you look at like the retail sector, where they're sourcing out of Southeast Asia, where Delta is more relevant now. I don't know. It just, to me, it always keeps coming back to this virus until it really entirely goes away, which may take some time. So it depends on the company and the sector you're looking at. But yeah, the story does seem to be supply chain. It's not a demand problem for most companies. I think the pent up demand story will continue, beyond that Q1, Q2, even Q3 as things have reopened. I think it's going to take time for demand to really catch up. So right now, supply is the biggest issue for a lot of companies, and so that's why I kind of refer to it as more mixed, because it doesn't seem like those supply pressures are going to be going away anytime soon.
All right, Craig. And just for those who might be new, Craig is who you know as Trend Tracker, and you stressed the prudence in stock picking, especially heading into earnings season and coming out of it. And you've been fairly active in some of the names. I know you added to Roku today. Why don't you talk about that trade a little bit?
Yeah, so this is a stock that I bought back in May, and they're positioned really, really well in the future of the television market as it shifts away from cable and towards internet connected TV. Their competitive position is very strong. They're the leading operating system for internet connected TVs. I bought this stock after Q1 results were strong, but the stock didn't really get rewarded. It rallied up to a record high and has now kind of pulled back. Ad tech stocks kind of remain out of favor. I think there's been increasing competitive concerns. Amazon started selling its own branded TVs, but they've been selling their Fire Stick for a long time too. One of the reasons why the Roku has seen such a huge gain since its IPO is because it was wasn't really taken seriously at first. They're competing with Apple TV, Google Chromecast, Amazon Fire, but their independence and focus on just this business has really benefited them well. Anthony Wood, who came from Netflix, the CEO, is really establishing himself as a visionary, and a lot of the partnerships that they're making, they're really strongly positioned here. So I think that this 30+% drawdown is likely a good entry. This is back where it was trading in May when I bought it. So I think this is a good entry for the long term. The stock is not cheap, with a maybe low double-digit, low teen sales multiple. But if you look at a lot of other ad tech peers growing at a similar rate, the long-term opportunity, the valuation is reasonable, and the long-term opportunity is still immense. I think they just entered the German market recently. They're in the UK. I want to say Brazil as well. The future seems to be very bright for basically the leading set-top box for TVs. So yeah, I added to that one this morning. Recall they blew it out in Q2, but a little bit softer viewership trends are what really hit the stock a month or two ago, and now the stock has kind of just drifted lower here. So I do think it's an opportunity.
All right, Craig. Now there's another name that you like a lot, and that's Affirm, AFRM. Let's talk about that one. That's seen some recent volatility.
Sure. When this one came out IPO, I was pretty cautious for a while, and it's kind of approaching back to where it was at that time now. It was, I think, trading around 40 times sales soon after the IPO, and I just didn't see why it would be worth that kind of premium valuation. And all the way, and the stock went from low 100s, like it got as high as close to 150, and was trading at 50 a couple months ago. So I felt like I was, I sort of nailed this one, just being cautious. But all the way down we've had a lot of subs that have been a fan, and the long term, this is the leader in buy now, pay later, and signing deals with both Shopify and Amazon recently really kind of establishes them as the buy now, pay later company. Like PayPal's in it, and everybody's trying to get into it. But I mean, I had bought something on Amazon where they had offered me their own buy now, pay later. I could pay in increments instead of using my credit card, but then I would be opting out of my credit card points instead of just paying for it in increments. So the fact that they kind of went to Affirm for that, when it seemed like they maybe could have just done it on their own. Obviously, when it comes to e-commerce, Amazon and Shopify are the two big players. So this last report last week was solid, and I mean, just the amount of growth that they're seeing in terms of customers, partners that are offering their service is kind of staggering. So, I started a small position yesterday. I took a quick profit. So I just have a smaller position in it for now, but I think it's likely worth accumulating on weakness from here because it's really established itself as the far and away leader. They're partnered with Walmart too, I believe. I mean, they have every partnership you could want. So the future seems pretty bright.
All right. And speaking of the future, you are pretty active checking out these new IPOs. I want to discuss the pipeline and some of these that you really are excited about.
Yeah, the pipeline is really strong right now. And as you know, I really like following these new issues. There's a lot of interesting retail and tech and consumer companies in the pipeline, which are right in my wheelhouse. Dutch Bros is one tomorrow that's going to start trading, and I am not super familiar with it, but it does seem like a very exciting restaurant franchise. Obviously, Starbucks kind of sets the tone for what could happen long term. But I think Warby Parker is going to be coming soon. Next week, we're also going to be seeing Toast, which is essentially a square and pretty much solves the tech stack solution for any restaurant, and their growth has been really, really impressive. So that's going to be a big one next week. But there's a couple other exciting restaurants in the pipeline as well. Obviously, the public markets are awarding some very generous valuations. So, now coming out of the pandemic, now's the time to come public. So I think we're going to continue to see a lot of exciting companies float their shares, and it usually leads to some good opportunities. I've generally done pretty well with IPOs. Was it Monday.com over the summer where, I kind of said, oh, this thing is expensive, and it had a sudden drop on the first day. This was June 10th. And now I basically took a quick profit that day, and I think a couple days later, and the stock is pretty much doubled since then. So, you kind of have to plug your nose with a lot of these. Even Dutch Bros, it's going to be expensive, but I guess you have to focus on the long-term opportunity, plug your nose a little bit, and there is a lot of recent IPOs that have done really well. So I'm just going to keep my eye open for those opportunities.
All right, and we'll be anxious to see which ones you might dive into. I'm going to bring in Damon, aka Scalp Trader, for everybody. And Damon, you've been doing more of that old-fashioned day trading lately, haven't you?
Hey, good afternoon, Jim. So again, I've been focused on the SPACs, and we've been seeing some really good volatility there. Combination, I think, of aggressive shorting and as well as hedging in this space has created opportunities, especially once the SPAC deal closes, for big short squeezes. So you've seen names squeeze 40, 50% on certain occasions in one day, in a couple hours on certain situations. So there's been a lot of that going on. There's a lot of SPACs out there. I've been bullish on this space for quite a long time, and I think what I'm starting to see in the price action is really positive in terms of the waves of volatility. And so what you're seeing is a period where the SPACs will run and outperform, then they get wiped out, everything falls altogether, and you can pick through and find attractive names that you want to buy for the next run higher. And when that run happens, it can be extremely quick. Some of these names are running 50, 100% in a week, 2 weeks, sometimes 40, 50% in a day or two. So I'm actively kind of maintaining my list of SPACs and stories. And one of the interesting things about the SPACs is that the deals are having terrible outcomes in terms of investors are able to ask for their money back. You're seeing a lot of redemptions, and the cash is not making it to the actual closure of the SPAC deal. So a lot of the SPACs are having to either reduce their valuation or put far less money on the balance sheet. So it's kind of making it interesting. I think the ones that are reducing valuation are essentially creating some type of value right out of the gate, but also you're seeing deals break down when the SPAC market is bearish for that period of time. Once a deal closes, it's likely to break down to the $7.50, $8 range, and possibly even lower, even after they've cut the valuation of the deal. So it's creating opportunities to buy things in the $4 to $6 or $7 range, and positioning them for a move higher on a swing term basis.
All right, toss out a few names that are really attractive that you throw on your radar and are must look at every single day that you're trading.
It's kind of it rolls based on price action, based on deals closing. A couple of names, we were I think last strategy meeting, I was super positive on Rocket Lab, saying it was my favorite name, and it was around 11 then, pulled back to around 10, and lifted off to 21, trading around 15 or 16 now, and we've been trimming on the way up. I think we trimmed some like 17, 18 recently. Still an interesting name, and I like it on pullbacks. ACIC is one of the electric helicopter plays. Interesting name. There's one of the SPACs that had to cut their valuation. They cut their valuation pretty significantly in order to finalize the deal. I think that's one that the story has a long way to play out, long-term story to play out in terms of getting their aircraft in operation, generating revenue. But it can be a story stock, a theme stock, and so I think you could get a speculative move in something like that. It's trading around $10 now. It's actually trying to see a little bit of a squeeze today. One to keep on the radar. I think it's one that makes sense to have at least a starter position in, and then you kind of trade around that, buy more as it goes lower, trim into upticks, and hopefully you get like a major pullback in SPACs that allows you to kind of really load the boat at a much lower price. But you never know. I mean, this thing could go to 20, before it goes to 5. So another one is ASTR. And it is a rocket/space place, very similar to Rocket Lab. It is a recent de-SPAC. I'm hoping to see it pull back into like the 8s in order to kind of officially put on a swing position. Might not get that, but this again with the space SPACs, it doesn't take much to get these things up 50% to a double. So I really like some of these names. There's some space data plays like, what is it, BSKY, I think it is. BKSY, which I think is one that Gavin may have mentioned last week. And there's another one, Redwire, RDW, that I think is interesting. So, again, I think that the best trade, given that we've had a really big run in SPACs over the past couple of weeks, is to really kind of wait for the next shakeout and start to accumulate names. Because when those shakeouts occur, they can be pretty swift and extreme. So something could go from $11 to $7.50 pretty quickly. So it's a matter of being patient and trading around the short-term price action.
All right, so it sounds like you are doing your best to take advantage of that volatility. Anything else from the swing trading perspective you got your eye on?
Not really. I mean, my opinions about just the valuations of things. So right now, I kind of look at the market as a video game to some degree, right? You try to win, you try to recognize patterns and take advantage of situations where maybe people are leaning out too aggressively, either short or getting flushed out of something that has decent value. So I like SPACs. I mean, I think in general I do a lot of that, when I look at distressed, or if I look at like preferreds, high yield preferreds and bonds. I like SPACs for that right now. In terms of the rest of the market, I guess if there's some momentum things that pop up on a theme basis, I'll probably take a swing at some of those as they come along. But I'm just looking for kind of the what really connects with me, and things that many times if I buy them and I don't, based on kind of a relative value and kind of a long-term story approach, I don't necessarily mind holding them for an extended period and waiting for them to play out. I still feel very strongly that you'll, in the SPAC space, you will see 10x opportunities. Stocks that you'll buy at 5 or 6 that'll go to 50 or 60, and it's just going to require some patience for those setups to develop.
All right. I don't want to leave any stone unturned. It does look like we will not be having Scott, blue chip trader, in today. Doesn't look like he was able to make it. So unfortunately, we won't get his input today. But with that said, is there anything else that we need to cover? Or any other parting shots that you guys may have, or any trades that we may have left just hanging out there that we need to address?
Yeah, nothing for me. I'm looking around at opportunities. Obviously, a choppy market getting ready for earnings season coming up, and curious to see what the market does around the Fed, if anything. So I haven't been as aggressive. Been looking more for opportunities in futures myself right now. That's kind of where I still stand at the moment.
Jim, I wanted to just give a brief update on the two stocks that I was kind of obsessed with this summer were Upstart and Novavax. And Upstart has done really, really well, doubled from where our most recent purchase was in June. I'm down to a very small position, and I'm just hoping that we see another big drawdown so we can buy more down in below 150 maybe. Novavax, we're up in, but it's a tense situation. I'm just patient, trying to be patient, and hopefully this company will get its vaccine approved in all the different jurisdictions, and this stock is still has a ton of upside if everything goes as planned, but it's going to be tense in the meantime. So as I've noted in the past, like if there's a stock that I harp on every day, it usually means that's where my conviction is. So Upstart worked out, and we're still kind of waiting on Novavax.
All right. Thanks a lot, Trend Tracker, for that update. Anybody else? All right. I will take that as an assumption that we can go ahead and wrap this one up. So we should have a recording out in the not too distant future. I'll get working on that right away. And as always, gentlemen, I want to thank you guys for joining us and giving some strategic approaches over the next several weeks. Appreciate that and joining us. And I think I speak for everyone out there listening. Thank you for the time and all your good ideas.
All right,
Okay,
no
thanks,
problem.
Thanks, Jim.